All right, let's dive right in. Today, we're going to pull back the curtain on one of the most exciting and, let's be honest, sometimes frustrating moments in the market, that massive, explosive stock breakout.
So, have you ever been there? You're watching a stock, it's doing absolutely nothing for weeks, and then the day after you finally give up and sell, boom, it rockets up 30%. It feels totally random, doesn't it? But it's not. There's a hidden story playing out right beneath the surface, and that's the puzzle we're going to solve today.
You see, the real secret to understanding these huge moves is knowing that they don't just appear out of thin air. There's almost always this quiet period right before, a kind of silence before the storm, where all the energy for that big breakout is secretly being stored up. So let's peel back those layers and see what's really going on. Now, that quiet phase, it's all driven by this powerful market idea called supply absorption. I know, it sounds super technical, but trust me, the key to understanding it isn't buried in some finance textbook. Nope, it's in a simple box of biscuits. So let's imagine a little mystery, and at the center of it is India's most famous biscuit, Parle-G. Believe it or not, this simple story holds the entire secret to stock breakouts. So in a normal world, everything is running smoothly. We've got our distributor, he's got about 30 local shops, and each shop needs one box of biscuits a month. That's a steady, predictable demand of 30 boxes. Easy enough, right? But then, one day, the factory just stops. Now, what's fascinating is that at first, nothing really happens. I mean, with 17 months of inventory just sitting there, there's no panic. But as the months tick by, that inventory starts to shrink. And men, here's the crucial part. When the supply is almost gone, the price just gets stuck. Think about it. The distributor doesn't need to offer discounts anymore. If you want biscuits, you have to pay the full price because there are simply no cheaper boxes left. Every last biscuit is being absorbed by eager buyers. And that, right there, that is the aha moment. That exact same thing, the supply drying up and the price getting stuck, is precisely what happens in the stock market just before a huge move. Let's just map it out to make it super clear. The warehouse full of biscuits, that's just like all the available shares for sale in the market. The demand from the local shops, that's buyer demand. And when the distributor completely runs out of boxes, well, that's the market running out of people willing to sell their shares at that price. The supply has been totally absorbed. And this idea sums it up perfectly. All that buying pressure happening during that quiet time, it's like coiling a spring. The price gets squeezed and squeezed into this really tight range, and it's just building up this incredible potential energy. And you know what they say, the longer and tighter that spring is compressed, the more explosive the release is going to be. Okay, so we get the why now. That makes sense. But how in the world can we actually see this coiled spring on a chart? Well, this is where we start looking for the specific footprints that supply absorption leaves behind. And two of the most famous footprints are the Volatility Contraction Pattern, we'll just call it VCP for short, and the Darvas Box. Now, they might look a little different, but they are both telling us the exact same story. Supply is drying up, big time. So what's the real difference between these two? Honestly, it all comes down to location, location, location. A VCP has to form right up against a resistance level. You know, that price ceiling where sellers have always shown up in the past. When the price coils up right under that ceiling and just won't go down, it's a huge clue that those sellers are running out of ammo. The Darvas box, on the other hand, is a bit more flexible. It can pop up anywhere while the price is just taking a breather, and it creates this really clear box-like range before its next big move. All right, let's take all of this and boil it down into a simple, actionable pre-flight checklist. The big takeaway here is that if you learn to spot these quiet phases, you can get in before the explosion happens instead of chasing it after the fact. These are the 4 conditions that tell you a stock might just be on the launch pad. Okay, here they are, the big 4. First, volume completely dries up. This is that silence we were talking about. The sellers are just vanishing. Second, volatility contracts. The daily price swings get smaller and smaller, like they're being squeezed. Third, the price refuses to drop. It just hangs out right near that resistance ceiling. And finally, number 4, the price range gets super, super compressed. This often creates what traders call inside bars, where one day's entire trading range fits inside the range of the day before, like a set of nesting dolls. Let's look at this in the real world. Check out this chart of Mahindra holidays. Look really closely at the area I'm highlighting. See how after that run-up, the price action just gets incredibly tight? Those tiny little candles, Those are the inside bars we just talked about. And look at the volume at the bottom. See how it just fades away? This is a picture-perfect example of the spring being coiled right before that breakout. And here's another classic example. Look at DJ Media Print. I mean, the price is literally stuck inside this perfect little rectangle, a classic Darvas box. Now look down at the volume bars. See how they've shrunk to almost nothing inside that box? That is the silence. The supply has been absorbed. The stage is set. So here's the most important point of all of this. Understanding these patterns fundamentally changes how you look at the market. It can shift you from being an emotional reactor to a patient, calculated strategist. Think of it like this, okay? The institutional smart money, they're boarding the train while it's sitting quietly at the station. They're buying during that boring, quiet consolidation phase we've been looking at. But many retail traders, they're driven by FOMO, the fear of missing out. They only notice the train after it has already left the station and is hurtling down the tracks. They end up chasing it, and that's a very, very risky game to play. And that really leaves us with one final big question for you to think about. When you look at your own trading, your own approach, are you learning to spot the signs of a train that's waiting patiently at the station? Or are you spending all your time and energy chasing after the ones that have already left?